back and relax. You're listening to episode 243 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features news, information, and analysis all around the best practices for wealth management technology. I had a great episode in store for you where I spoke to Jeff Coyle, founder and CEO of Libretto. Libretto is an interesting financial planning application, a little bit different than most of the financial planning tools, and Jeff will tell you all about it. But we covered things such as how they're different, how they quantify risk tolerance differently without questionnaires or without a Monte Carlo, how they use liabilities as a framework, how they are priorities-based planning, which is different than goals-based planning, and how they integrate and deliver portfolio management recommendations. So there's a lot going on there, and you're really going to be interested, I think, when you hear from Jeff in this episode. But before we begin, let's talk a little bit about RIA tech stacks. I know you've got one. If you're an RIA, you've got a tech stack, and most likely it's old and out of date and got a lot of problems. It's a little creaky. It needs some oil here and there. It needs some tune-up probably. If so, you should run, not walk to our website, EzraGroup.com, and fill out the Contact Us form on the homepage. Our consultants at Ezra Group know everything about wealth management technology, specifically around RIA tech stacks. Our team has hands-on experience, either as in operational roles at RIAs or with all the vendors you know and love and work with today. We've got them on our team, and they can come in and help you optimize your current platforms, evaluate your systems and technologies, run RFPs or vendor evaluation processes to select new technology, implement tech technology, optimize it for you, and get you running, take you to the next level to supercharge your growth. So please go to our website, EzraGroup.com, and fill out the Contact Us form on the homepage to help you with your tech stack. A couple of quick housekeeping items before we begin. Please subscribe to the show wherever you listen to podcasts so you don't miss an episode. Check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. All right, now let's kick this thing off. And here we go with our next, I'm excited to introduce our next guest. It is Jeff Coyle, founder and CEO of Libretto. Hey, Jeff, man, glad you are here.
Well, thanks for asking me to join you.
Absolutely. And where are you calling in from?
I'm from Los Angeles.
Fantastic. We were just talking about snowboarding. Mammoth Mountain's a close. Do you ever go to what's the mountain closer to you, like 2 hours away, where that kid, snowboard kid with the red hair goes to snowboard?
Yeah,
what mountain is that?
Yeah, that would be Big Bear.
Big Bear, right?
Yeah,
right. It's like 2 hours east of LA, right?
Yes, it is. It is.
I wanted to go there, but it was raining, so I drove 7 hours to Mammoth. That was not a fun ride.
No, but it was a good choice.
It was great when I was there. It was fantastic, but yeah, that's a long ride.
Yeah, it is. It is. The snow's better, bigger mountain. It's worth a bit more effort. Yeah. I
thought so. It was fantastic. Cool. So let us get started with this interview. Give us, if you will, 30-second elevator pitch for Libretto.
Oh, sure. Libretto is really your control panel for delivering personalized advice at scale. And everybody needs a clever tagline, and ours is, make every client feel like they're worth 100 million. And where that comes from is, our background is really managing the wealth of the most affluent, and the methods that we use are more robust. However, those methods are far more important to regular people, and the reason they can't afford to make mistakes. So Libretto, basically, what we don't do is we don't use risk-based questionnaires. We don't assign a model portfolio to that risk-based questionnaire answer, and we don't run a Monte Carlo. What we do is we build personalized solutions using more advanced asset liability methods. And as we do that, there's 5 things we do. We manage the full financial structure. We incorporate every current resource, every future resource, every liability, and every objective. And then we apply priorities-based planning so that the strategy is fully aligned with the life that the client envisions. And then that priorities-driven planning process basically drives a personalized portfolio construction process that uses liability matching methods. And then, of course, it takes more than a portfolio to achieve a series of outcomes. And Libretto will help you to systematize the application of insurance, entity structure, tax minimization, other non-financial solutions. And when you're done, you're really delivering a family office experience, which, by the way, is just a fancy name for comprehensive wealth management. It's the same thing. So Libretto really is seeking to bring more advanced methods and make sophisticated wealth management easy.
What I thought was interesting about your product, there are a lot of vendors out there that offer financial planning tools, and we are experts in that area. We do a lot of research in financial planning, just like every other technology in wealth management. But in financial planning, usually there are firms that the application will start out as mass affluent and then add features targeting high net worth that are, estate planning and other tools that are targeting high net worth. But you're going the opposite. You built a high net worth platform that you're now targeting mass affluent with. Would that be a fair assumption, a fair statement?
It is, and that's a really good insight, because it's much better from a process perspective. It's much better to start with an ideal framework and then actually make it more and actually simplify it after the fact. It's much more difficult to take a simple solution and try and make it more complex, because the foundation that you're working with isn't as robust. So if you start with an ideal solution, the foundation that you're working with is ultimately robust, and your ability to organize it to be delivered to different client segments is enhanced dramatically.
Going back to something you said, you don't use risk-based questionnaires. So you don't run Monte Carlo. So how do you, when you're building an asset allocation, how do you quantify the client's risk tolerance, risk capacity, and other parts of that risk?
Well, what you do is you basically align someone's strategy to the life that they envision. And that's kind of critical. So when you give somebody a risk-based questionnaire, it's really a risk preference. Am I a risk taker? Am I a risk avoider? What's missing in that puzzle is the actual purpose the money's designed to support. When you instead start the process by identifying the family's priorities, they have a personal lifestyle that they'd like to live. They have objectives they'd like to accomplish with their family. They like to affect society in some positive way. And each one of those outcomes, you can then actually identify each one and then prioritize them. And some of those are essential. You want to avoid risk. Some of those are important. You can take some risk. And some of those are discretionary. You can take more risk. So what's actually happening in an interactive, enjoyable conversation with the client is actually identifying the suitability of taking risk, not the preference, but the suitability of taking risk. The other thing that we know from that conversation is not only the suitability of risk, but we know when every dollar is needed. So what we've just identified is we've helped the client to articulate the purpose of their wealth. And then they've identified the timing and characteristic of every dollar they're going to spend. And then what we can do is we can take each one of those dollars and then match it with suitable asset allocations. And thereby, when we roll that all up, we basically have a highly personalized strategy. And that strategy is entirely aligned with the life that they envision. Every asset is serving a distinct purpose.
Jeff, allow me to press you a little bit on something. So when I hear the word suitability, to me, that says broker-dealer. Broker-dealers talk in suitability, whereas financial advisors, financial planners talk more in fiduciary or, in risk tolerance and risk assessment. So what do you mean by suitability, and how do you align that with risk tolerance and risk capacity?
Really, in a broker-dealer framework, suitability is really a function of, can I sell this product to a client? Is it suitable for them, right? In a planning context, it's entirely different. It's more that the client is actually saying, hey, we want to be able to sustain a significant downturn if it occurs. We need to be sure we can cover our essential spending if it's necessary. And because it's essential spending, it's not suitable to take risk. That's where we avoid risk. On the other hand,
Okay.
on the other hand, we might want to buy a second home in 7 years. And that's a discretionary objective for us. If we can afford it, that's great. And because of that, it's suitable to take more risk. And so in this case, it's the client that's actually communicating the suitability of risk to us as they prioritize each one of their outcomes.
Do you have a list of questions for the advisor to ask to gather that information?
Yeah, we do, but it's completely a natural interactive process. You really start when you kind of deconstruct what somebody's trying to accomplish. You start with their lifestyle and you identify what their total lifestyle spending is. And then for a retired couple, as an example, you would then say, well, hey, if we were back in deflation of the 30s or stagflation of the 60s to 80s, what could you get by on, stay in your home and be okay? And that's really essential spending. And so what we do there is we can immunize that essential spending for the rest of their life. And this is real risk management. We can put a hedge in place, short of the US government going out of business, they're going to be just fine. And so that is an example of somebody identifying an essential need. It's very easy to do. How much do you spend? How much of that's essential? Now you move on to your children. And it's interesting, there's really nice frameworks. Warren Buffett has a wonderful adage, which is, I'd like to give my kids as much they can do anything, but not so much they can do nothing. And when you think in that context, you'd say, well, what would I like to accomplish with my kids? Would I like to afford the best education possible? Would I pay for a wedding? Would I buy them a car when they got out of school? Would I help them with a down payment on a home? Would I give them a supplemental income so they could make a career decision not based on economics? These are frameworks, and it's just part of a process. And the reason it's nice is when you do this frequently, you actually learn what most people would do if they could afford it. You can put that into a framework very easily. It makes the conversation very easy and enjoyable. And then families can immediately identify, well, what would we like to accomplish with our kids? And why would we like to do that? And then the last component of this is what we call social influence. And that is, you're philanthropic. And usually people are nervous to give because they don't know if they're personally covered and their family's personally covered. But once they understand that their personal lifestyle is addressed and their family objectives are addressed, now they feel much more confident to give. And that basically empowers them to be more proactive and cause change in the way that they like to see change affected more positively. So it's a really nice, easy framework. Using this system, it's designed to be an interactive planning process. When you meet with clients, you bring it up and you basically have an interactive discussion. It takes about 15 minutes to review their financial condition, and they walk out of there with complete confidence.
What more can he ask for? I would love to have complete confidence. That's one of my goals.
That's interesting, Craig, because one of the things that I particularly am interested in is, what's interesting is most families are already financially successful. They just don't know it. And the reason they don't know it is because they don't fully appreciate the value of their human capital. That's the present value of their future earnings. It dominates the wealth of most wealth-building families, and yet they're completely unaware of it. And they're also unaware of the present value of their Social Security benefits. So for a typical retiring couple, the present value of their Social Security benefits is worth somewhere between $1.25 million and $2 million. And the reason that's interesting is that even families that are earning minimum wage can put their kids through college and be financially successful. And so the key to success is really just starting early enough. And there's two things you really need to do as your wealth building family is just one, size your life appropriately. Don't spend too much. And then secondly, earn your human capital. And when you think in a liability framework rather than a probability framework, you go directly at the problem. And that is to say, well, how do I increase the confidence I earn my human capital? Well, I'd buy life insurance, I'd buy disability insurance, and then I might want a protective reserve. It's a protective device when you're in your wealth building years. It says, well, hey, maybe I want a year or two of spending. So if I lose my job during a downturn, I've got the time to retrain and find another job and start saving again. So the key is the framework it's very intuitive, and yet it's just a bit more robust.
I like having liability framework built in. That's really a new idea for a lot of financial planning tools, is including liabilities. We were so focused on assets for so long, we kind of really forgot about liabilities are just as important.
Yeah, and there's two kinds of liabilities, and the one of which is the liability a banker thinks about, and that's a mortgage, right? And the other kind of liability is, hey, I need to be sure I can spend an essential dollar for the rest of my life and a non-essential dollar. So those are spending liabilities. But if you kind of go to the asset liability picture, go to the mortgage for a minute, when you build a strategy for someone, one of the things that Libretto enables you to do is to manage the full financial structure. And what I mean by that is when you build someone's strategy, you actually incorporate their home and their mortgage into their strategy. A mortgage is a type of opaque leverage. It basically elevates your exposure to risk assets. And you want to be aware of how that leverage is affecting your structure. You also want to incorporate someone's human capital. That's the present value of their future earnings. It just dominates the wealth of most affluent families, and yet they're completely unaware of it. And when you become aware of it, it changes the way you think about solutions. And as I just mentioned, Social Security is a non-trivial asset to families. It's worth $1.25 million to $2 million. And what's interesting about Social Security, it's really a long-term inflation-protected bond that directly addresses longevity risk. And so what we really want to do is we want to fold Social Security into the bond structure so that we don't unintentionally over-allocate to fixed income, which is generally the case. And then as you start to work with more complex families, you fold in their operating businesses, their properties, their other private assets. At every wealth level, you fold in expected estate inflows from the generation above, insurance payoffs, maybe royalties. So what's really happening is when you're building a strategy, a portfolio is not a 60-40 portfolio because somebody answered moderately aggressive. It actually behaves like a completion fund. It recognizes all of those other resources I was just identifying, and it fills in the voids to create a comprehensive solution. So when you think of liabilities, yes, your mortgage is a liability. Now, all of those resources I just described, how do we align those resources so they serve the needs of the family, the personal, family, and social objectives of the family? And those are their spending liabilities. And so what you're really doing is you're systematically saying, how do I match all of these resources to support and achieve those different objectives or spending liabilities?
So Jeff, you talk a lot like a high net worth advisor when I hear you talking. So we just diverge for 2 minutes. How did you get here? You founded a couple of high net worth advisory firms. You were an executive at Northern Trust. Why get into the software business? This is a dirty, messy business. What made you to jump ship from the investment side, the advisor side, to the software vendor side?
I've been doing this for quite a long time. And, by the way, I started my career working with families of normal wealth, and then I built systems that were more valuable to people of more complexity. And so I ended up at a place called My CFO back in 2000, and I was the chief strategy officer and head of investments. And our average client was 125 million at the time. And I worked on the larger clients. And so that's where I learned to work with families with wealth into the billions. And back then, there were no systems to actually manage that kind of wealth. And I had been building them for years before I got to my CFO. And the nice thing about my CFO was a technology-based firm. And so we were actually building my systems back then. And that's in a career, that was probably the biggest gift in my career, because when you kind of walk around the world every day, you kind of do things in a generalized way. When you have to build it into technology, it forces you to think at the fifth decimal point. So that level of rigor really really stuck with me. And then I started 3 ultra affluent advisory firms. I also built systems for managing that wealth. Northern Trust, they acquired my last system. I spent 2 years there as their deputy CIO, institutionalizing that across their firm, and wonderful experience. And now it runs their firm. And so and then I kind of retired for a bit. And I didn't retire, but I took some time off, and I had to build some tools to manage our own resources. And I finally figured out something that eluded me for 2 decades. And that was the whole asset liability matching process within a unified planning and portfolio and wealth management construct. And that's where Libretto comes from. And it's interesting. It's, yes, I've managed the wealth of very affluent families, but these methods are so much more important to people of normal wealth levels, because you can't afford to make mistakes. And that's what motivates us, is to bring these methods to the broader population.
That's an awesome goal. Thanks for giving us a quick overview. I was looking at some of the screenshots you sent over. I did have a demo of Libretto, but it was a while back.
Mhm.
What I remember, and looking at your screens, I like how you've got a lot of other things in this list of priorities besides just their current assets, your normal assets. You've also got parental support, weddings, education, all listed under priorities. So how does that fit into, when you talk about asset and liability matching, how do you do that matching process, and how does that fit into, and what kind of portfolio management are you actually doing? Is it a full-blown portfolio management, or is it a light portfolio management?
Oh, no, it's a full-blown portfolio management. In fact, it's a type of portfolio management that's more rigorous than what most people will see. And the first thing is you started in exactly the right place, which is, well, what are the priorities of the family? And what's interesting, people can articulate this beautifully if you just set up the proper framework. You ask the right questions, and that's what the technology does. It enables you to set up the framework and ask the right questions. So, the first question is, well, how much do you spend? And then you help to identify, if someone's retired, well, how much of that's essential? Well, I'm going to basically protect that. And in our case, we're actually going to protect it with a hedge. They're going to achieve that outcome. And this is not a probability, it's real risk management. And then you move on to their family objectives, and they'd like to put the kids through college, and they'd like to augment the spending of their parents because they need to. They'd like to give $1 to charity. And each one of those objectives of theirs, they've prioritized. And so they've identified and said, hey, this one's essential, avoid risk. This one's important, we can take some risk. This one's discretionary, we can take more risk. And once you know that, going back to the original question, the suitability of taking risk, but we also know exactly when every dollar is needed. So we can then actually identify and say, hey, if it's a discretionary objective that's needed in 10 years, we know exactly how to invest that dollar. And when I say that, when we assign suitable asset allocations, another way of saying suitable asset allocations, we actually define factor level exposures for that dollar. So if that dollar needs a bond, what should be the term of the bond? Should it be short or long? What should the credit quality be? High quality or low quality? Should the bond be a fixed coupon, or should it be inflation protected? And then we have similar types of risk exposures that relate to the equity structure. So quite literally, every dollar will be described by 7 different factor exposure, some of them fixed income, some of them equity. And at that point, we know exactly how to invest every dollar. And then we can take each dollar and we roll it up. And now we know how to invest for university education. We know how to invest the 529 plan. And then we roll all that up. We now know exactly how to invest the overall household portfolio. And then all we do, we just map the investments of the advisor to fulfill those risk targets. And all of that is done by technology. And that's the beauty of technology, is it can simplify very complex and sophisticated processes.
That is the beauty of technology, or one of the beauties of technology.
Yeah.
One of the things I was reading in your background information, and we understand a lot about financial planning. We understand goals-based planning and cash flow planning, but you use the term priorities-based planning. How is that different than goals-based planning? Isn't that the same thing?
No, it's actually fundamentally different. Now, having said that, this is the 3rd system that I've built, and the last 2 systems were goals-based systems. What's different about a priorities-based system over a goals system is a goal just tells you you want to accomplish something. But a priority tells you the relative importance in your life. And so you've identified that, yes, I'd like to put my kids through university education, but a priority tells you that's an important rather than discretionary objective, or rather than essential. A goal just tells you want to do it. And because you understand the priority, it gives you information about the suitability of risk. And now we actually know how to invest a dollar in a very systematic way. And so what a priority does is it gives us much more information. It gives us information around the suitability of risk and the timing of when the dollar is needed. And in that point, you can actually diverge from a traditional goals-based solution, because often what will happen is people identify a goal and then they'll say, hey, I'm a moderately aggressive investor. And then you say, well, if I'm a moderately aggressive investor, I get a 70-30 portfolio, and now I'm going to run a Monte Carlo. And all of that is really detached from the purpose of the actual asset, the priority in life. When you actually link all of that, every bit of that now starts to inform the portfolio. So it's kind of the difference between playing a piano with 2 thumbs versus 10 fingers or 10 digits. And that's really what happens. And so it's a far more robust solution, but it's super easy to implement. And so you can really make sophisticated wealth management accessible.
Jeff, we're running out of time. I probably have 1 or 2 more questions I want to squeeze in, because this is really fascinating to me. When you talk about systematizing the application of insurance entity structures, tax minimization, talk about a more rigorous portfolio management construct. Does your application have trading, rebalancing, performance reporting, those types of tools, or do you send that out to another application or another source?
No, we do and we don't. But so let me be clear about that. Is the way that Libretto, we basically have, we build integrations with portfolio accounting systems. And we have integrations with most of the portfolio accounting systems out there. And that data flows into Libretto. And now we have every position, every tax basis, every account, every entity. So we understand the financial structure related to current resources. But simplistically, half of the wealth of a family is not inside of a portfolio accounting system. And Libretto enables you to complete that. You add their homes and their mortgages, their present value of their future earnings, human capital, their social security, their pensions, their operating businesses, their estate inflows, their insurance payoffs. Now you have 100% of their financial structure. And now you can actually do some significant work with that. Now we can then say to a client, well, how would you like to allocate your wealth? Now that you understand the true value of it, well, we'd like to allocate it intentionally X amount to our personal lifestyle, this amount to our family, this amount to society. And as you do that, it builds just automatically a personalized portfolio expressed at a factor level. And then the advisor's investments are just mapped to that. And now they're implementing portfolios they're familiar with. On the other side of this, though, it takes a lot more than a portfolio to achieve a series of outcomes for a family. And what's nice about this, we now actually understand the value of their human capital and how critical that is to their financial success. So Libretto will actually tell you how much life insurance to buy because it knows that information. It'll tell you how big of an excess liability umbrella you might want. It can identify and say, hey, these are kind of the core estate planning documents you might want to use. And it can also help to identify non-financial solutions. Maybe somebody needs a healthcare advocate, or they should think about a donor advised fund as an example. And all of that is systematized. So what's interesting is when you kind of go into your question, when you move beyond a goal framework and a risk-based, think Monte Carlo framework, and you move into a personalized framework using liability matching logic and methods, it completely opens the door. And now you have an ability to systematize and unify the planning process with personalized portfolio construction and the application of comprehensive wealth management services.
Jeff, I can go on all day about this. I find this fascinating, and I really like what you've done at Libretto to try to do something different around financial planning. But we're out of time. Could you tell the listeners where they can find more information about Libretto?
Sure. Libretto, our website is libretto.io. And that's a great place to start. And if you're interested in a conversation, you'll find a place to set up a meeting, and we would look forward to speaking with you.
And we will have links in the show notes to the website, but it's Libretto with 2 T's. .io.
2 T's. Yep, 2 T's.
Excellent. Jeff, thank you so much for being here and sharing so much about your application and a little bit about yourself.
Oh, thank you, Craig. I appreciate the time.
Hey, it's Craig again. Here are my top 3 takeaways from this episode. All right, Libretto is a different financial planning tool. They are priorities-based, which is not goals-based. They use a liabilities framework that incorporates all resources like human capital, Social Security, not just the assets in the portfolio, and they include essential spending needs, matching all those resources to achieve objectives and build a personalized portfolio. Number 2, they can quantify risk tolerance without a questionnaire. They help the advisors align strategies for the client's life. And they identify suitability. Again, I press them a bit on the difference between suitability for a broker-dealer and suitability in the financial planning realm. And he described that, talking about priorities around the risk and timing of when dollars are needed to systematically invest each dollar. And finally, talked about how they built this starting at an ultra high net worth target and moved it down, simplified it for broader use, which makes it easier. You get to deliver the complexity and the capabilities, but in a much smoother and easier to use fashion. All right, you've made it to the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, head over to our website, ezragroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Every month, you'll receive an email chock full of wealth management goodness, news, information, updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.